Good evening and good afternoon. A very warm welcome to the last panel of iConnections Asia. I am Baldwin Choy, Head of Hedge Funds and Family Offices in Bloomberg. I run and look after the APAC hedge fund strategy for our business, looking at sales strategies to grow Bloomberg's franchise across financial data and enterprise solutions. I am thrilled to be back in Singapore, having just landed at 2 a.m. last night, but delighted to be moderating today's panel and our conversation amongst us on global credit outlook, APAC and beyond. I think we would all agree that we face an especially uncertain outlook. On one hand, we see the light at the end of the COVID tunnel, right? But on the other hand, geopolitical conflict, forceful monetary tightening in response to persistent inflation continue to weigh in on global markets. Today, it is my honor to have an esteemed panel of investors from all asset classes and geographies to discuss the current risks and opportunities in global credit markets that are experiencing a paradigm shift. As we start off conversation, I would like to invite each of you, starting with Johnny, to give a brief self-introduction and your view on the current market events right now and what is your top concern. Johnny.
Thank you. Thank you for having me, Johnny Adji. I'm a Senior Investment Director at Cambridge Associates. So I cover real assets for Asia Pacific as well as private credit and global core infrastructure. I've been with the firm for 12 years.
Johnny, want to share with us what are your current views on the current market and what is your top concern right now?
Sure. So the way that we see the current private credit market in Asia today is that there's definitely a market dislocation. And with that, there are opportunities to generate excess return or alpha. The key point here is where should you put your capital? Where should you place it? Obviously, everybody's talking about China. Everybody's talking about the real estate sector in particular. So in terms of our view, yes, it's an interesting place to be, but be mindful. There are two versions of it, your onshore credit, your offshore credit, and how do you play those two markets, and how do you make sure that you get access to the underlying collateral so that your secured credit is the critical differentiating point. Now, having said that, there are also other pockets of opportunities all around the world that's emerging, particularly around the US, for example, because of the recent large steps of interest rate increases by the Federal Reserve. We see also some market opportunities there in the US opening up.
Thank you, Johnny. Over to you, Norbert.
Yeah, good afternoon. I'm Norbert Ling from Invesco. I'm a portfolio manager focusing on public credit in both Asia, China, and emerging markets. Thank you for the opportunity to be here today. Certainly, this is a very historic year, I would say. When you look at the macro perspective, I think this is a textbook year that we all look back 20, 30 years ago. 4 times of 75 basis points increased by the Fed, and how real interest rates have gone from negative to positive 2% at the 30 years. So very historic times, and certainly very volatile markets for fixed income and public credit. Historically, I would say that a low rates environment is conducive for public credit. But if you look at interest rates volatility, we are 2 to 3 times in the last 10-year average. So that really comes to the question of what should investors look out for going into 2023. 2 main areas. Firstly, I would say signs of inflation moderation. I think this is one where we all focus on the last data point, but we need more sustained evidence of it. And I think this also comes to how a central bank behaves around the world. Are you data dependency in real time, or are you going to switch to forward guidance? So I think when we see signs of forward guidance by central bankers, I think that's a very positive sign for interest rate volatility and by extension for public credit markets in general. So watch the space for 2023. I think it's not just about soft landing, it's about how the central banks communicate and speak.
Thank you, Norbert. Over to you, Matt.
Great. Thanks, everybody, for hanging in there. I'm Matt Michelini. I'm the CEO of Apollo's Asia Pacific business. Echoing some of my fellow panelists, what they've said, what's going on in the market today. Every investor in this room knows the central banks have been pulling back liquidity and leverage that they've pumped into the markets over the last 15 years. The markets have responded more or less real time, both the credit markets and the equity markets, to this increase in cost of capital. You're now going to see it on the fundamental side. Inflation is at least here to stay and going to be relatively sticky in the medium term. The cost of financing is going to stay sticky in the medium term. Remember, rates aren't high. Rates are normal. And you also have increase in costs coming from supply chain. And so you'll start to see the fundamentals weaken as well. And so what's happened is that the primary issuance markets, both on credit and equity, are almost impossible to access, but for the best companies. And that's because investors have three problems right now. One is they're waiting for more certainty. Two is they don't have liquidity in their portfolio. And three, they're over-allocated to private assets at this point as their liquid books have dropped in value. But interestingly enough, this is the perfect time for private capital to step in, is when markets aren't functioning. And so we're seeing some of the best opportunities across credit, hybrid, and equity that we've seen since 2008. And so we've been very busy. Answering the follow-on question of what do I think investors should be most focused on in 2023? Look, there's a lot of things to be focused on. I think the single biggest challenge for investors right now is spotting the heart attack risk. We don't worry about the cancer risk or the default cycle. We actually worry about the heart attack risk driven by ALM mismatch. The central banks have pushed liquidity out of the banks and they've pushed leverage into the system that I don't think is fully appreciated. And so as they start to pull back, you're going to see massive capital calls for those business models that have relied on easy access to liquidity or rollover of leverage. And that's going to create a massive capital call or a sell of assets at distressed prices, take LDI in the UK. So I think that's probably the single biggest thing to look out for in 2023.
Hi, my name is Sreeni Prabhu. I'm the CEO and the CIO of Angel Capital. We are a US-based and US-focused credit manager. We look across credit in the US, but we focus more on structured credit. And within structured credit, we have a big team around non-government mortgage credit. So as Matt mentioned, we agree with these teams that this liquidity that has been taken out of the market is going to cause a big squeeze. This illiquidity has been caused on the financing side, not from the credit side. Now it will bleed into credit side, which is what our view is, but it has really been driven by the financing side. So liquidity is at a premium, we believe, and liquidity will continue to be at a premium because to make a call on where the Fed will end up and what that will do to the overall curve and overall spreads is something that is to be taken at some point in time. But what we do know is that there are opportunities being created. We manage across public and private credit, and there are opportunities on both sides. Specifically on the mortgage credit, one of the things that has happened, different from companies which might have borrowed at aggressive levels, the consumer or the residential mortgage borrower has fixed his mortgage rate at ultra low rates. And so the quality of the borrowers in the US this time around, separate from GFC, is in a much better position. But lending in the new world is extremely high, and that has caused a tremendous slowdown in residential credit and eventually will lead to housing credit. So to navigate through the cycle is important. And across credit, we have to watch what's happening in high yield, what's happening in other sorts of credit, but that's what we continue to focus on.
Thank you, Sreeni. Now, we have kind of inched forward into looking at what's our top concerns and where we see kind of opportunities. But before we go full on into that, let's look backwards for a bit and think about the past 18 months, right? Evolution of themes, rates, macro environment, all these kind of things. How has that impacted your investment and and how have you pivoted around that as well? Johnny, I'll start with you again. Okay,
so if you look at what happened in the last 18 months, I mean, definitely credit spread has moved up significantly. If you're talking about, the poster child, maybe the China real estate credit spread, right? It moved up by close to 6,000 basis points on the listed side. That's a lot, right? And obviously a lot of the people are factoring in the illiquidity issues, the probability of default, which may or may not materialize. So what you need to do is that you need to have the skill to pick and say, okay, which ones are likely to survive and which one are not. The good thing is the government has come up with a policy whereby, they will not differentiate between the public borrowers, meaning SOEs, or the private companies. They're trying to save the entire market. So hopefully more equal treatment, which is good, because traditionally the market view tends to say, look, if it's related to SOE, it's generally safer. So hopefully with that, our managers can pick up some return on that. So that's a positive. Now what we're worried about, and in terms of building our client portfolio, and some of the panelists, such as Matt has noted also, is that how do we make our client portfolio bulletproof, right? We've mentioned, a number of things. One, because of the decline in the public equities market, our clients are facing essentially, an over allocation to private, right? So how do you balance that out, right? Some of the pension funds, for example, in the UK, because of the, liability-driven investing, they need to basically liquidate some of their assets to meet some of the margin calls. These are the real problems that we're facing right now. So we're not saying like, look, stop, don't do anything, but we say, look, when you plan your investment program, when you think about investment, please make sure that you reserve, more liquidity, because that gives you the optionality to capture the market on the trough, right? Unlike, say, 18 months ago, it seems that everybody is looking for the higher yield. Now, if you have the ability, your pension plan, for example, right, is still having a positive net cash inflow, keep some of the cash and do a rifle shot approach to seek for the really, really interesting opportunities that we think will come in the next 12 to 18 months.
Thank you, Johnny. A very interesting point about having that liquidity and when to deploy it as well. That's very critical to our conversation. Norbert, how about you?
Yeah, I think certainly the last 18 months are very big learning lessons for in the financial markets and investing. So I'll try to categorize it into two main categories, top-down and bottoms-up perspective. I think from the top down, as you heard from the panelists earlier, watching policy pivots is very important. When central bank policies pivot, when government policies pivot, there was a comment about how China is moving out zero COVID policy and the real estate sector by the panel before. So these are signs that are very important from an investing perspective to watch regime change. And that's a very important source of kind of alpha when you think about how an active fund behaves versus a passive fund. So policy pivots are something that I couldn't emphasize more. Second point I would highlight is interest rate differentials across the regions, where they look at different countries, local currency, and dollar. This is a very big driver of asset allocation decisions and how money flow goes within the public space, or whether from public into private. So one very big paradigm shift has been how Chinese interest rates have been much higher than US interest rates historically, and now it's actually inverse. So what does it mean? Do you invest more in Chinese onshore fixed income? Do you invest more in Chinese US dollar fixed income? Or do you invest in US investment grade or down the securitized curve? This opens up all the different kind of asset allocation decisions that trigger off a very long-term kind of asset allocation processes. And if I go back to the bottoms-up perspective, I started my career as a credit analyst. Unfortunately, like many of my peers, we studied economics, really boring job. Only one course that we really remember from university is accounting and finance. So in credit, I think what bottom line is ability to pay and willingness to pay couldn't be more important in this credit cycle. And in the Asia and emerging market space, willingness to pay may not be demonstrated all the time. So able to assess it from a kind of single issuer sector perspective is important. If you think about what I mentioned from a policy point of view, if you do not pay your bonds, what happens to the owners of the company? Do you go to jail? Do you get a chance to start again? So that's why willingness to pay is so important. We talk about ability to pay, how's your business model? I think Matt brought up a good point about business models that are challenged from higher funding costs or lack of liquidity. Are you built for the normalized interest rate? So this ability to pay, it all comes down to numbers and also kind of on the ground due diligence. Last but not least, I think there was a comment that I picked up quite a few times about over-allocation to private because underperformance of public assets. So I think this is one very important point as a public asset manager in the fixed income space is measuring carry to vol is very important. So how do you deliver the client experience with the yield and return at the lowest possible volatility? And I think this is what clients are focusing on in 2023 and looking at uncorrelated and diversified asset classes in a fixed income product.
Thanks, Norbert. We will revisit that part about public versus private later as well. Matt, pass the time over to you.
Sure. Okay, last 18 months has been a volatile ride, so I'll start with about 12 months ago. 12 months, everything we do, whether it be credit, hybrid, or equity, comes with the philosophy of purchase price matters. What that meant 12 months ago was being top of the capital structure, senior secured, originating our own credit through our own origination platforms so that we can control the risk box, whether that's aircraft leasing, triple net lease, auto fleet leasing, sponsor finance, actually making sure that the credit box was set right for that environment. On the equity side, and so the reason why we wanted to focus on purchase price matters is, and why that, and how that resonated 12 months ago, is it meant that we were making sure we weren't investing in anything that was going to require us to play defense 12 months later, or 18 months later, or whenever central banks were going to start to tighten and you'd start to see some weakness on the macro front. And we also spent time raising capital. So we raised about $100 billion of capital in the last 12 months. And when the time came to invest over the course of the last quarter, we put to work about $37 billion. That was more than double what it was the year prior. Where we're finding the most interesting risk reward, still senior secured, top of the capital structure, investment grade and high yield, mostly in the US and Europe. On the equity side, we found really interesting opportunities, but they've come with additional elements of complexity. And then we've also focused our platform on raising capital and raising funding for big major sectors that are short funding. Hybrid, which is senior equity. Most allocators have a fixed income allocation, an equity allocation. They don't have a hybrid allocation. Secondaries. There's going to be lots of rebalancing of portfolios, especially as the liquid markets have traded down. And so we've focused on forming capital for secondaries. And probably the biggest one is climate transition or energy transition. We've all read the statistics about how much is going to be required to fund the world's transition. There's not enough capital in the world to satisfy that. And so we want to make sure that we've got the capital in sectors that are structurally short capital. So that's where we're finding the best opportunities and how we've focused the platform over the last 12 to 18 months.
Thank you, Matt. Sreeni, over to you.
Yeah, I mean, this year has probably been one of the most challenging years that we've had as a firm, and we started right after GFC, which was an extremely challenging environment. And this time around, you went into this year with good credit, right? And it was purely driven by inflation and the Fed just absolutely jawboning, rightly so in their mind, to tame inflation. So as I mentioned, we managed through public markets and private markets, and everything you bought this year is underwater. I mean, that's just a fact of investing. But I'll start with the public side. We have mutual funds that invest in structured credit, and we came into this year with a lot of cash. I can tell you that we did not have any idea how fast and furious the Fed would go. So I would be lying if I said that. And but we did know that this would be a challenging year, and it proved to be extremely challenging after March of this year. So we really stayed on the sidelines for a long period of time, and fund flows were also dictating what you could do in this environment, and that's on the public side. And as we mentioned, private markets give you a little bit more flexibility because of the fact that it's longer duration in terms of investment process. But that being said, we're seeing extremely attractive opportunities on the public side going in, where the yields across structured credit, which were approaching 2 to 3% yields, are now approaching 7 to 8% yields on senior bonds in structured credit. So if you take a relative value approach, not making a call on when Fed will be done, but making a call that spreads across credit are at wides historically. And if you want to start buying into it, this is the right time to buy it. As Matt mentioned, they're doing it at Apollo. But on the private side, we have the same engine where we originate our own non-government mortgages. We have a sister mortgage company. And so we could control our destiny. So one of the things that we did was we really slowed down our production of mortgages all through this year. And that's one of the things that we can discuss here is what we'll find out coming out of this cycle is there's not been much origination that's been done, because it's hard to originate anything, whether it's an auto loan or mortgage loan, when next day morning it's out of the money. So there's a lack of supply that's happening as we speak, but there is enough assets out there trading at pretty attractive levels. So we think there's a short-term opportunity to buy what I call legacy assets that we're originating over the last few years. But then there's a lot of opportunities to originate new assets at very attractive levels. For example, non-government mortgages that were trading at 4% December of last year are now approaching 9% at this point, just to give you a perspective.
Thank you, Sreeni. Johnny, I want to come back to you for a bit. You spoke a bit about the market dislocation and the relative valuation between APAC and EMEA. Assuming now, we were very studious in keeping liquidity, where would you see pockets of opportunity right now?
Okay, so can I take some of the key points that the other panelist members have taken, right? So, going back to your point, Norbert, the fundamentals of credit, right? Ability to pay and willingness to pay, these two are very, very different things. And to take on, Matt's comment and Sreeni, your comment as well, right? Having the ability and access to the underlying collateral, cash flow of the business is equally important, right? And some of the other panelists also talk about, okay, you, for example, Matt, you've done a lot of, for example, aircraft leasing, right? And our clients are also exposed to aircraft leasing, shipping, and et cetera. These are good lending businesses to have. But you need, the key message is that you need to peel the onion further and really need to understand what you're getting into. So a typical, 70-30 asset allocation broad brush, I don't think can work very well in this type of environment. You really, really need to be a sharpshooter. You really need to focus on where and which niche market, right? Just to give an example, aircraft leasing is a great business, right? But if you're exposed to Aeroflot, for example, as the lessee, then you'll encounter problems, right? So as part of the way that we think about the credit construction here is that how do you make sure that you diversify your portfolio enough so that one 2 sigma or 3 sigma event will not derail your entire portfolio? So let's talk about that, right? And typically, investors would just say, okay, for each and every commitment that I make, that should not exceed, for example, for large investors, 1%. For smaller one, maybe 2 to 3%, at most 5%. This is how you basically limit the risk, right? And within that risk limit, we typically invest indirectly through funds. So they'll probably have, 8 investments, 10 investments, 20 investments. So if 1 or 2 blew up, it will not create a big hole, and excuse the pun, right, in the ship, so that you'll basically sink the entire portfolio. That is the key message. In terms of how do you identify this, we've already talked about, the US side on the public is interesting, senior secured is interesting. Asia on China, be it, public market side, private market, we think is interesting, but the key point is how do you get a hold of the collateral? Some of the, credit or leasing businesses in the new asset, right? Matt, you talked about the green energy. Our clients is actually, one of the owners, right, of one of the largest ROV vehicles or ROV ships that service the wind turbines. Our clients have also allocated significant amount of capital in green energy, be it wind and solar. And our clients actually own one of the largest fleet of LNG carriers outside of some of the majors, right? So this is how we also use the collective capacity of our clients, the financial capital, to actually create something tangible for the world also. Because we need to also remember, if we cannot sustain our planet A indefinitely, right? We don't have a planet B. There's no plan B, right? So we need to think about investment in that context. It's not only about, how do I tactically generate return for the next 12 to 18 months, but rather we need to think, okay, how do we generate a long-term stable return, not for our generation, for the next generation? Because we advise, for example, endowment funds. We advise, for example, family offices. They're already in the 3rd, 4th, and the 5th generation. So we're talking about legacy here. And I think let that be the legacy of us as investment professionals.
Thank you, Johnny. I just want to share a quick story that I had from this morning when I was hosting a family office breakfast. We were talking about direct investments in the company. And companies in ASEAN countries might not know what is impact investing. How do I become more ESG friendly? The example was, let's say I give you X number of dollars, put a certain small amount into just simply changing the light bulbs in your office to become LED. Kickstart small baby steps conversations like this, and I think it's quite meaningful as well. Norbert, I'm going to come back. I'm going to come to you next. I know you are very involved on the ESG space, but in terms of demand for funding, we can see that there are industries like mining, coal, right, that have higher demand for funding, how do you then, I guess, structure a loan or make sure that they adhere to ESG standards?
Thanks for this question. Every panel, if there's no ESG coming out, it's not the right panel. So at least we are on the right panel today. First, I think Matt talked about the kind of climate transition needs. If you think about GDP, percentage of GDP spending, there's a need to spend 8% of GDP every year for the world to hit net zero by 2050. So this is a very significant financing gap that the world needs to navigate. And a large part of this actually sits in emerging markets, not just in developed markets. So how do we actually balance this need for financing for people who need it, for companies who need it? I think from a public debt perspective, there are two main angles. One is certainly innovation. What does it mean to finance these companies? Is it green bond? Is it a carbon credit-backed bond, for example, where you have carbon credit as collateral? Are you talking about a climate adaptation-focused bond? Are you also looking at different structures that have more unique features that ensure the reporting standards that you require from an impact perspective? So I think this is where innovation is really key, where categories that may not fit a green bond can find a home in an investor or asset owner. And a second point I also want to say is the focus on material emitting sectors is very important. So that means how we finance money to, whether it's a coal plant that's going through the journey to become renewable, or how do you pay for climate abatement costs and climate adaptation. So these focus areas, I think, will be a very big focus for many funds, and these are currently still financed by public bodies. So the private sector needs to step in with blended finance solutions to facilitate their transition. I think at Invesco, I would say we are quite similar to many of our peers. We've all signed up for the net zero asset manager commitment. So I think as an industry overall, any asset manager is all focusing on how you drive to net zero. And this is a KPI that's all reported in our annual ESG reporting. So we got to deliver the talk that we made in our commitments. Yeah.
Thank you, Norbert. Matt, this is where I come back to you when we spoke about public versus private. I understand for Apollo, you have the flexibility to look at opportunities across the spectrum, from investment grade to direct lending to special sits. Now that we've spoken about where are some of these opportunities and themes that we can rely on, how are we pushing into it in terms of a product offering as well?
Yeah, good question. So I like to joke that we are the best lender of second resort. So if you can access local capital, bank capital, or syndicated markets, you should do that. If you can't access those markets, then we're probably the best lender because of the flexibility of our funding platform, where we can do everything from investment grade credit all the way through equity. Today, being the lender of second resort, we've been very busy. So in the US, we're buying investment grade credit at better than 8% plus. During LDI, I think my CEO had said on our earnings call, we were a third of the primary market in the UK, I'm sorry, of the secondary market in the UK, as pension plans tried to sell their highest quality collateral to generate liquidity. That was single A, double A risk at better than 8% returns. We're seeing the exact same phenomenon in high yield, where we are putting money to work, top of the capital structure, 10% return, 10% plus returns in high yield for really defensive businesses, market-leading businesses. And so those are really interesting opportunities coming out of the US and a little bit out of Europe, although I think Europe still has a little ways to go before repricing sets in. In Asia, you haven't really seen that repricing by and large. It's likely coming in pockets, but you haven't really seen that in Asia. On the structured product side, as many of you read in the headlines, we like structured products. We bought Credit Suisse's structured products business to supplement our own large business. But structured products is interesting because you can actually generate 200 to 300 basis point uplift relative to the comparably rated corporate single issuer credit. And when you look at any length of period in terms of performance of those structured products, you actually have better loss ratios than single issuer corporates. And that's because of the diversification, as well as the structural enhancements that came about post-Great Financial Crisis. And so we like structured products. We're seeing a lot of very interesting opportunities in structured products. Spreads are at getting closer to 2008 wides for pretty high quality collateral. So structured products in the US is another big area of focus for us in this environment. And the last one is, as you mentioned, special situations. We define special situations a little bit differently because we approach it with a little bit more of an equity lens. Our belief is that and everybody has a belief. Our belief, though, is that the next 2 to 3 years is going to be much more difficult for equity holders than credit holders. And that's because there's a significant deleveraging that has to happen across the globe. And all of the things we talked about in fundamentals needing to re-rate to higher cost of capital, higher inflation, different supply chains, that's all coming out of equity, not coming out of credit. And so for hybrid, so we've been approaching hybrid a little bit differently in saying, how can we be a provider of re-equitization capital for many of these companies, where they don't have to take the dilution that they're going to have to take by issuing common equity. This allows us to be downside protected in the capital structure and still share in the upside of equity. Yeah, that's point one. The other point is when you look at equity, whether it be infrastructure, climate, even some of the levered REIT structures, yield equity is very, very interesting. That for a long time, yield equity has been undervalued in some respects because it didn't have growth. And now when you have a nice, stable yield equity, you can actually buy that at very attractive prices. Again, that's mostly coming out of the US and a little bit Europe. Asia has yet to reprice, but I'm still hoping. But those are the big areas that we've been focused on globally.
Thanks, Matt. Sreeni, over to you. Want lend a US lens to this discussion as well?
Yeah, I mean, a lot of the stuff that Matt said, I agree with it. And by the way, Matt, we have a public REIT if you want to take a look at it. It's highly attractive from a yield perspective. Look, there's plenty of opportunities, and I do think that US has re-rated itself and repriced itself faster than the rest of the world. And we don't invest in other parts of the world, but we look at it. It's all relative value at the end of the day. And so there are different types of opportunities that are developing. The public market structured equity, structured credit is, I think, extremely cheap relative to any time in the past. And I wouldn't. It's not like it's a fleeting opportunity, but it's a short-term opportunity or a medium-term opportunity where people can put money to work. And there's going to be eventually on the backside of this, there's going to be a lack of supply that'll eventually catch up. And so whether you buy asset-backed securities or what we focus on, which is non-agency mortgage-backed securities, to a certain extent, CLOs are extremely attractive. Now that being said, liquidity is still at a premium as we speak, and we have to be careful. So, going and putting all the money to work today is not what we emphasize, but dollar cost averaging over the next few months. I mean, we would like to think that we are closer to the end. We don't know where the end is than at the beginning, which is what we were in January, February of this year. So that's on a relative value basis. That makes sense to me. On the private side, one of the things that Angelo focuses on is we are a lender to what I said is a new group of non-qualified borrowers, mortgage borrowers. And what that really means is small business owners, self-employed borrowers, people that own rental properties. A lot of them are disqualified from having government mortgages in the US, and they were disqualified coming out of the financial crisis as new rules got created. So there was already a lack of investing in that space, and COVID, number one, and now the rate moves, number two, has really made it very difficult for these borrowers who are wealthy borrowers with lots of money to put down for their homes, and they just can't get mortgages. So as a private lender and for private assets, there's a lot of ways to really put money to work. And now you need patience, you need to be liquid, you need to have a long-term horizon, and there will be opportunities. And as we speak, we're looking at yields close to 9 to 10%. So we haven't seen that for a long time.
Thank you, Sreeni. Very, very good. No, Johnny,
Can I make a quick comment based on all the panelists' remarks? I mean, as the investment advisor for about 1,000 LPs globally, ranging from sovereign wealth funds, pension funds, up to family offices with $150 million of assets and above. And I assume most of the audience here, you're manager of third-party capital, fund managers. Can I encourage you guys to include the ESG element into your due diligence or even into your loan documentation? We're seeing some managers in Asia, they're starting to do that. We'd like to encourage more. And I think the focus these days has mostly been on the E And somehow the S and the G got fallen off by the wayside. And I'd like to encourage you guys to also, Sreeni, when you talk about, the qualified borrowers that can access the banks, those are the S and the G impact, right? That sometimes it gets crowded out by all the E environment bits. So we like to encourage you to basically promote that, make sure that there's a balance between the E, the S, and the G. As a firm, we're also very focused, for example, on minority ownership, be it in terms of the manager's ownership, or if your strategy is geared towards, for example, affordable housing in the US. Those are some of the things that we really like in terms of the risk return, and also on the S and the G part. And in terms of the credit, I don't know if there are bankers out there in the audience today, but today what we're seeing is that banks in Asia have made a very good step in terms of green bonds. Our equity managers are getting it at about 15 basis points less than a quote unquote typical competitive market rates. Can you please do more? Because we're all in this together, and everybody need to do a little bit on their own, so that cumulatively together we can make this work.
I invite you to read our 100-page ESG report.
Sorry, come again?
I invite you to read our 100-page ESG report as a firm.
Yes.
We've implemented these processes. Even in Asia Credit, when we invested in Ampol, we gave them a discount for achieving ESG targets. So we agree.
Thank you.
We've adopted them, and we encourage feedback from you as you look at them.
Yes, let's have a more detailed discussion.
Same here.
I actually want to pick up a point, Johnny, you raised really well. So myself, I manage a Sustainable China Bond Fund, and I will actually say that having ESG is the difference between survivor and not survivor. We've seen many instances where a corporate doesn't have a transition story, it doesn't get the financing from the bank. So if you think about where a corporate assesses liquidity, public markets, asset managers are very focused on ESG, what Matt talked about. You look at our ESG report, you go to the banks have sustainable financing target, private capital space, engagement closed down. So if companies do not have an ESG policy or ESG strategy to survive, they will not get the financing. And I can share with you an example of a Chinese high yield issuer who tried to tap the public high yield market at 6%. It did not manage to print because of the market volatility, but because he had a credible ESG strategy, the banks extended it financing at 4%. See, this is where ESG strategy actually allows a corporate to survive through this volatility. And also as an investor, I would like to invest in an ESG positive company, whether you get it from E or S metrics, as Johnny said, both are equally important, because this is a sign that the company plans to be around the next 10 years and 20 years and have the cash flows to repay you. So it comes to what we talked about, the learning points. This focus on E and S and G together as a package is so important.
I love how the final question, all of us came in together, and I quote Johnny, we are all in this together, and be it deploying capital or structuring these kind of deals, we all have our little steps that we can play. On the note of COVID, with cautious optimism, I did bring a mask here as well because I flew in from Hong Kong. I would like to ask everyone, what is the one lesson you've learned both professionally and personally through this? Johnny, I'll start with you.
Interesting. I think Warren Buffett probably said this, right? The thing that'll hurt you the most is things that you know that is true but turn out not to be true. And I think COVID gave me really a humbling lesson whereby something that we thought so remote and could almost like the likelihood of happening is zero actually did happen. So, it caused us to really go back to our drawing board and say, okay, what are the potential impact and what are the potential trajectories of COVID? And at the back of my mind, I thought like, okay, if the opening up of the world will not be in synchronous lockstep, there's going to be potential disruption when the world opens up. But I guess what I did not clearly foresee, say 18 months ago, 24 months ago, is that the impact on the supply chain and how much it will drive the inflation pressure. At that time, I would have thought that, okay, at least 18 months, 24 months ago, we're at somewhat more balanced full employment. And if you open it up in a lockstep, inflation should not be the primary driver for all these price increases. But what I didn't forecast was, I guess, China being, having a continuous lockdown that creates ripple effects all across the world. So to me, that's my personal lessons learned.
Thank you, Johnny. Norbert?
I think my personal lesson is more humble. I got married during COVID times, so I think personally it was a big experiencing deflation and inflation in different parts of the wedding planning exercise. I think from a professional standpoint, I would say being a student of history has never been more important. One of my favorite books this year actually has been Ben Bernanke's book about 21st century monetary policy. So as we think about every year in financial markets, which year in the past does it most look like? So I think that to me is a very big learning point about this COVID story.
I wanted to read that book, but after the scathing review of Bernanke in The Price of Time, I couldn't read it. Look, I mean, the lesson learned, I mean, I don't want to state the obvious, but that the government can shut down the entire society and we'll all survive. I don't know. I'm not sure I knew that fact before going into COVID.
I mean, for us, we're a young firm, so we finally had our stress test in the firm, which is a complete shutdown of the financial markets. So we had a good disaster recovery. We actually were able to trade. We were actually a team work together. So any testing that was supposed to be done, we got it done at that point. So that's the one thing. Thank God for that. You know, personally, I mean, you know, it makes you think about, as we mentioned, you know, how things can change on a dime. You know, how many firms run stress tests on, you know, what happens, and there you go. It's a 15 standard deviation move that happened in a spot of time. So you know, that's when you go back to your family, you hug your kids and your wife, and you come back to work next day.
Thank you.
Yeah.
With that, my personal lesson, both professionally and personally, was empathy. I think it is one of the most important things, and to Johnny's point, back to the drawing board, back to the basics, back to what is really important to each and every one of us. With that, thank you for joining us. Thank you, the speakers. On the last funny note for you to remember us by, we kind of tried to color coordinate in alternating colors if you don't, if you didn't observe. But thank you. Have a good evening ahead, and thank you for today.
Thank you.